set of financial statements, explain and account for changes in accounting policies, revisions of accounting estimates and errors, identify and analyze related parties, explain and account for discontinued operations, explain and account for events after the reporting period. So with the financial statements, we talked about this earlier, that it consists of a combination of a statement of financial position, a statement of profit and loss and other comprehensive income, statement of changes in equity, a cash flow statement, the notes, comparative information, and also a statement of financial position at the beginning of the earliest comparative period when you make any changes in your accounts. Now let's go through each of these in turn. So a balance sheet is, the idea behind a balance sheet is that it's going to be a stock concept, right? So it's going to be the resources that the company controls at a point in time. And what exactly forms the balance sheet is that we've got three major components. Is that we've got assets, so the resources that you own and the resources that will help you generate an inflow. You have liabilities, which is something that you owe to others. And when you settle that, it's going to result in an outflow from your company. And then equity, which is the difference between asset minus liabilities. Now, for most of these balance sheet items, you only recognize them in the balance sheet if it is probable that the transaction is going to occur or it has occurred, and if it can be reliably measured. Now, one of the key elements of the balance sheet is that we have this current versus non-current distinction, which is that if you have items in the balance sheet that will be realized within a 12-month period or over a normal operating cycle, then that goes under the current component of the balance sheet, and anything that is beyond this period goes into the non-current component. We then go into the income statement, which is largely a flow concept. And so here it's going to be the income and the expenses that the company has managed to generate or pay out over a period of time. And so in the financial reporting process is that at the end of each financial period, the P&L activities are closed out and they are shifted into the retained earnings proportion of the balance sheet, so that when we begin a new financial period, that everything begins from zero and the process starts again. Now, with the statement of income or statement of profit and loss, there's going to be a component known as other comprehensive income, which are simply changes in reserve accounts or changes in the equity section of the balance sheet. But these changes in equity clearly have an impact for shareholders. And so what this component of the income statement tries to do is that it tries to cover these events because they are ultimately going to be impacting shareholders and equity holders. And so the common examples of these events include things such as revaluation of land and buildings. So if we think about a company, let's just take Bunnings, for example, they buy a land to build their warehouse. And they've bought the land 10 years ago, it was $100,000. Today, because interest rates are so low, that land is worth $1 million now. And so when Bunnings decides to revalue that land from 100,000 to $1 million, they're going to be revaluing that by an amount of 900,000. Now, this 900,000 is clearly not going to be income from their normal operation. Bunnings is a retailer of like tools and hardware, but the revaluation in itself has clearly generated a benefit for shareholders. And so this type of transaction would be classified in other comprehensive income. Some other examples of this include foreign currency translations of overseas subsidiaries. And so if, for example, there's BHP, they have a big subsidiary in Mongolia that subsidiary is not Australian dollar denominated, and so BHP will look to convert that subsidiary's activity back into the presentation currency, which is Aussie dollars. There will also be changes in the fair value of investments that will also go through comprehensive income, along with changes in any fair value hedges as well. And so finally, in this unit, you'll also see and be able to account for changes in